Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we welcome back Corey Rosenbloom. This is his third webinar on BMT. If you did not see the previous two, I highly recommend them. They were very well received. And he did one on anticipating reversals in advance, and another one titled Tactics for Success. You can find both of those on BMT. Before we get started, I want to remind everybody that Corey is not a BMT site sponsor, so as always, this means the webinar does not include any selling or any kind of secret sauce. Everything is educational only. If it does turn out that you're interested in anything that Corey has to say, you can always contact him after the webinar. The webinar is being recorded. I'll post the recording on our YouTube channel later today. If you're watching the recording at a later date and you like it, then please give us a thumbs up. It does help us out. All right, as you guys have questions, you can type them into the questions box, and we'll do our best to get everybody's questions answered today. I'm just noticing right now that, like always, when it comes to these psychology-based webinars, I mean, there's about 700 people on BMT right now, and there's less than 100 people in this webinar. And, you know, I just find it slightly amusing from watching all the people on BMT and watching their activities, and they're always looking for indicators and, you know, where can I get an indicator that tells me when to go long or short? And people are less interested in doing this type of work, which I think is really the most important type of work that you can do to improve your trading. But anyway, I will get off of my soapbox, and I will turn things over to Corey. And let's see. Whoops, I just muted you again. Okay. All right, Corey, you should be good to go.
There we go, Mike. Can everybody hear me? Make sure we're okay?
Yeah, and I have one quick question
Excellent.
for you I forgot to ask.
Sure.
Do you want to take questions as
Absolutely.
they come, or do you want to hold them until the end, or how do you want to deal with it?
See, I'll pull the questions out. There'll be a couple times because it'll break up the hour from just me talking the whole time. So I'll break it up probably 2 to 3 times during the presentation where we'll take questions.
All right, just let me know, and I'll read them
And
out
of
to you.
course at the end, absolutely at the end.
Okay.
Absolutely.
All right, thanks, Corey. It's all yours.
All right, well, everyone, thank you for attending. And Mike, again, thank you for having me back. I really enjoyed the group and the questions and the feedback, and a lot of respect for what you all are doing. So definitely, you have a great group of contacts here. So use yourself as resources, communicate, use the forums. That's one thing that helped me a lot with respect to trading when I got started, was the ability to interact, to ask questions, and to share successes and share things that weren't successes, and that's helpful too. Not every day in the market will be perfect. So it's good to kind of lean on your fellow traders, lean on your leaders, lean on those who you respect, and of course just other traders that are going through the same things you are. And that's just so important as we're trading and developing our confidence and developing our strategies. And I love what you said, Mike, with respect to the strategies and the indicators, the secret sauce, all that. Trust me, if there was anything that was like that, I would either I would have it or someone else with the contact would have it. It just doesn't work. It's day in, day out, probabilities, studying the market, interacting with traders, and just making this as fun and as enjoyable as possible as we engage with the market. That's really what we're doing, just engaging in the market every single day. And so with respect to that, we'll go ahead and start. And I'm not one for intros, I just want to jump into the material here. But all trading does involve risk, and that is absolutely the case. I wish that were also not the case. I wish every single day was a T3 or one of those powerful trend days. We started having a trend day today, but we diverged and actually reversed all the way to the lows. So these things do happen. So trading does involve risk, no matter what indicator, strategy, method that you use. So just keep that in mind. That's the first thing we always talk about, is trading involves risk. Just quickly on me, if you're familiar with my methods, I'm a technical analyst, so I use the market for most of what you would do is pattern recognition. Reliance on indicators, mostly emphasis on trend. So I'm always looking for the continuity of a trend and for signs of possible reversal. We've discussed these on prior webinars with Big Mike, and those are in the archives too, just with respect to trading tactics and really what I do. But came in quickly to the market as an investor, and when that was really the tech bubble, We'll talk about cycles and adapting later, but that's when I got started, luckily or fortunately, in respect to this large rallying bubble. And the swing trading tactics came in after that, when fundamental analysis, which is basically buy, 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 there really isn't much to go with sell. It's buy and hold. When the market fell, even if you outperform the market, you're still losing money. So that's when I got involved in technical analysis, and specifically me as a swing trader. And that led to 4 years of really not intermarket, but sector rotation, so trading off strong stocks, strong sectors. That led to ETF trading as well. And when I went full-time after graduate school, have been in the intraday markets ever since. And that's where I like that. I would typically trade S&P futures and otherwise leading stocks in leading sectors, for things that are overnight or swing positions. I still do a little bit of that, not as much as I used to in the mid-2000s. Received, and we'll talk about this, education, CMT, Charter Market Technician, 2009, and then we started blogging. Now, I mentioned that with respect to the communications and networks and forums. That's what helped me a lot, develop strategies, network with traders, and just share the ideas, share trade setups, share what I was doing, successes and failures. Don't just say everything's perfect. Sometimes the best education we get are from the word failure probably isn't the word, but losing trades or trading slumps. When things aren't going perfect, that's when we rely on other traders and do a lot of communication that way. So one of my goals in speaking at the Traders Expo 2009 was to move to Los Angeles. And so I accomplished that goal a few years later, last year in October. So I'm happy to be presenting to you from Los Angeles, California, just south of Hollywood. And I come to you from Alabama, from Huntsville, Alabama. So a little bit of Southern culture in here with some big city Los Angeles. So all right, enough about me. Let's go ahead and talk about psychology. So the main thing for what Mike mentioned earlier, with respect to trading success, I think a lot of it comes down to strategy, which is knowing what to do, the indicators that you use, the trade setups that you take, bull flags, bear flags, head and shoulders, all those fun things. But if you don't do it, if you don't put it into practice, that's where psychology comes in. That's where that's vitally important, is to know what to do, put it into practice. So that's what we'll talk about. We'll focus our entire attention really on today's webinar on psychology. There's another component with respect to adapting to changes, and in my 13, 14, 15 years of doing this, I've seen market conditions change from tech bubble euphoria to buy the dips, and the dips kept breaking, which is a tech bubble crash, low volatility recovery 2004 until 7, the deterioration of the markets and sector movement as the housing crisis bled over or spilled over into the financial crisis, and that took down the entire economy and took down the stock market powerfully. That was a very radically different environment for swing and intraday traders than the low volatility creep, which is about what we're seeing now. We're seeing this 2004 to 7, just not much volatility, upward trending market. Swing trading is typically favored in those environments, but the point is adapting. What we have now is this liquidity-fueled, stimulus-fueled economic recovery that is pushing stock prices higher than probably otherwise would be without stimulus, but that's part of the adapting. So those are topics for, I would say, multiple webinars, but right now let's just focus our attention today on psychology. The trading process that we talk about, and focus on these when you're trading. It's a lot to take in. There's many, many books, many, many webinars, many, many things that we reference. If you can simplify as much as possible, I think this is key to success, at least for me, which is making everything quantifiable, putting it in the simplest terms as possible. For the process, study in the evening or the after the market closes, right now or something, what happened, what's setting up, what sectors are moving, what stocks are moving, what depends on your strategy. Recognize opportunity, which is if you find a setup. For example, a market is forming a support level, trading into a support level, and expect maybe there's a reversal candle or something like that, and we expect the market to trade up off that level. That's opportunity recognition. And the trade entry comes maybe the next trading session with respect to playing off that target, playing off the break of a high, playing off the break of a trend line, or something like that. It is a specific entry into a trade setup that you recognized from your planning. And that typically leads to an initial target and initial stop. This will define risk reward and position sizing. Managing the trade typically refers to trailing a stop or exiting before or after a target is hit if there is new information entering the system. And of course, position sizing taking off, sizing off half, adding to existing, so on and so forth. And the final component, which is trade exit. For those of you that are into performance or sports psychology or performance disciplines, this is a good way to break down the trading process into concrete or specific skills. The skill of studying, which that's not that difficult, it's just looking at charts and looking for opportunities. The skill of entering a trade, psychology plays in that. The skill of management, so on and so forth, and exit. So where does fear short-circuit this process? We'll study. Well, hopefully none of you are terrified and sweating and nervous when you're studying the market. If so, that's not a good thing. When you're recognizing an opportunity, typically you're not, when you're scanning your stocks or looking for breakouts or whatever that you do, probably you're not fearful in that sense. The fear tends to come in when you're taking the trade, when you're putting the trade on. So that initial entry component. What it does, and just think of what fear does and how it short-circuits that cycle, which is not taking a trade or sizing too small based on what your account size would be. Trade managing, which is exiting before a target or a stop is hit. So that's just a case of managing a trade that's positioned open, exiting before the target. Oh, I have some profit, I'm going to go ahead and take it when the profit would have gone higher if you follow the rules. Or the stop loss. Well, we just had a conversation with a colleague this morning, and we're talking about traders who, and this happens to us too, nobody's perfect, when the market's entered a support level and it starts to break initially, the stop maybe is 2% away, but this market moved 0.5% and you go ahead and take that stop. Well, it's going to go ahead and stop me out anyway. Well, that's not quite following your plan, but the fear of making a large loss or trying to keep a little loss small is what short-circuited that system. And finally, it's the exit component, which is not exiting or holding on to a losing trade. That happens all the time. So it's just, fear in the sense of just overanalyzing or just hoping and praying or whatever the case is that this trade will work out and not taking that stop when it should be triggered. There's a lot more than this, but let's just focus on 3 specific types of fears. The biggest one, the most common, I would argue, is the fear of losing money, which is not definitely a goal to avoid loss of capital. It has to happen in a probabilistic environment, but that's something we always try to avoid if at all possible, and I would say large losing trades. And this would be a single trade or a series or a back-to-back series of trade losses. It typically shows up in our trading as hesitation, doubt, not taking a setup that triggered. Otherwise, not being right. That's where ego plays in. So psychology and ego and pride, particularly if you're a public figure or just talking with your friends and you're long Apple or long, Tesla or something like that, or Amazon, before those stocks started trading lower, before they reversed, people ask you, oh, are you still long Tesla? Well, yeah, it's going to go up. Yeah, definitely. And all those sort of things here, the ego plays in that overrides your system, particularly stop losses. And finally, this is the opposite one, which is missing out. How many times have we said, oh, this market can't go any higher, and the moment it retraces, I'm going to get long, or if it breaks out, whatever the case is. But the market keeps going up. And so the fear of missing out, or same thing with comparing with your colleagues or other people on Twitter, other people in the trading group or the forum here, if you're not participating in it, you feel left out. So missing out can cause you to overtrade, size a position a little bit too largely, jump in too late. So if a trend is showing signs of weakening, divergences and non-confirmations and maybe some breakdown signals, but you go ahead and get into it because your other colleagues did, that's a trading error. Or sizing in too large, so trading too frequently, jumping in too late, not using signals basically, and sizing your position too large. So that's typically how fear affects us. The model, if we talk about trader psychology with respect to how fear grips us or how it happens, how it develops. I think it's important to figure out what happens, what goes on, and how it affects us personally, because it's a nebulous topic. Trading is a big topic. Fear is a big topic, or psychology is an even bigger topic than that. So throughout the presentation, keep this in terms of your own trading successes and weaknesses. So personalize anything you talk about with respect to trader psychology. So typically we start out with enthusiasm and optimism and success. We see people making money and seeing success, and we think we can do that as well. So hopefully we have some initial success with that, trading maybe a small account, and we get lucky or just have a good position or good management. That often, especially if you do have initial success, and that's what happened to me and most traders in the Market Wizards book, Jack Swigger, initial success, and then they do this. The next stage is arguably, it almost happens to almost every trader, which is overconfidence, seeking risk-seeking, focusing on money, focusing on what your account would buy, what the money buys with your account, with your trades, which typically leads to a big, painful trading loss. You're over-positioned, you don't take a stop, and that stop just continues to get worse. The loss continues to grow. Hopefully it doesn't result in a blowout of your trading account, but if it does, you're not alone. These things do happen, and they happen to some of the best, or have happened to some of the best traders. So prevent that if you can. If you're a new trader, this is not the route you want to go. Listen to professionals, listen to other colleagues in the forum, or whatever the case may be. Use the others as experiences. The result of that, losing half your account or getting your ego, hurt by a position that goes against you, fear, anxiety. You avoid risk aversion. You hesitate. You, again, size too small. Don't put the trades on when the system calls for them, the indicator, the strategy, the support level, the resistance level, and you just don't do that. And again, that shows up as trade avoidance or position sizing too small, or holding on to a losing position that should be stopped out. Focusing on this and kind of going into the future, when a person goes through this cycle, this model, typically, the next result is to seek knowledge. For me, that resulted in a CMT, which is a 2-year, kind of almost graduate school course, going to traders conferences, reading as many books as I can. So this is natural. This is normal. This happens. The end result is that you seek knowledge. You realize, okay, well, I can do this. This is doable. I see other people doing it and having success with it. What must I do to become like them? Simple. Learn as much as possible. From this typically develops a strategy and a more respect for the market. This way you're not just completely bullish or completely expecting the market to pay out rewards and good trades. You realize risk is inherent in trading, so it develops a grounding sense of what to expect. This does lead to strategies. Hopefully we take this pathway, which is we begin to respect risk. We focus on risk management. And all the disclaimers and webinars that we read, which is trading is a risky game that can lose money, we understand that completely because we've done it. We've had it happen. So we do respect risk. We do take our stop losses. We do hold until the target is hit. We perform trade setups without hesitation, and that leads to consistency in results. Doesn't mean it's going to lead to rapid profits every single day, but just consistency over time. However, this is what we want to avoid. This is the avoidance pathway. When you're seeking knowledge, learning everything, developing a strategy, we seek more knowledge. We learn everything, and we never trade again. So Mike was talking earlier in the introduction about traders who seek that magic indicator, the secret sauce, that strategy, the guru, the book, whatever the case is, but they don't put it into practice. Going back to our model, it's knowing what to do, doing it, and then adapting to market conditions as they change. So more knowledge, what is it? Knowledge is a dangerous thing. What is that proverb? A little knowledge is a dangerous thing. So yes, it is if you don't trade again. If you say, well, I can't take this setup until this indicator and that indicator, they all line up. Or, if I just take one more course, if I read one more book or go to one more seminar, then I'll trade, and that leads to another one, and so on and so forth. So we wish the pathway to be this upward rising pathway, not this knowledge leads to more knowledge, leads to more knowledge, leads to hopefully perfection, and that's an unattainable, unachievable goal. There's nothing about the market that gives you money every single day, and there really isn't a perfect setup. It's always, each one's a little bit different. So we just manage the risk as we take those each day. So for me, it's reframing the trading game. Define fear. Understand what it does to you, how it affects your particular trading style and your particular account, what markets you're trading, how you're engaging the market, and how fear thwarts or really affects you and negatively affects what you're trying to do, which is to make money consistently. How does fear short circuit you particularly? If you see trading as a threatening, or the market makers, or the high frequency traders, or whatever the case is, they're out to get you. They're going to get you. You put that stop in, they see that stop, and they run that stop, and ha ha ha, that kind of thing. Well, that's maybe, but that's framing the game as a threatening, fear-based gotcha environment. More than not, how you frame the game is how you play the game and how you succeed or fail at the game. So we'll take a kind of the little first third of the way through the presentation. What is trading? Whoops, gave it a little secret away. If you type into the chat box here, what is trading to you? Before I kind of frame it, it's good or bad. What is it? Is it this risk parameter? Is it a great thing? Is it a bad thing? Is it fun? Is it entertaining? Just type into the chat box here, what is trading to you particularly? Yeah, Vaughn says trading is a big auction. I love that. That's exactly how I define it. Trading is a big auction. Yeah. Anybody else want to jump in? Rick, yeah, good. Rick says trading is a part-time job. Trading to Rick is a part-time job. That's perfectly fine. One thing about trading, just quickly, is that it can be whatever you make it. If you have a full-time job, you can trade swing trading or longer-term position trades. If you're a part-time person with a part-time job, you can trade part-time. You see your scanning, execute, put on trades, put your stops, put your targets in, and let the market do its thing. Or you can be a full-time intraday trader. It's whatever you want, however you engage the market. That's how you create the games. Absolutely. Rick is a part-time job. A few people said, actually 3 right in a row, David, Sanjay, and Fritz, they said trading is a business. Yes, yes, yes. Trading is a business, and the trades we put on are just like inventory. So we take inventory at a low price, hopefully hold on to it for a little bit, and sell it at a higher price. And of course, losses are just part of the business. So if you frame it that way, you don't see a trader, say a florist or a cake maker, when they purchase flour and sugar, or the flowers, or the vases, or whatever they purchase for their business, you don't see them stressing out and freaking out that, oh no, we had to buy, this, had to pay a repairman, and so on and so forth. It's just trading. It's the losses, the expenses are part of the business. In trading, when a trade goes poorly or the stop is triggered, treat it as the same thing. Well, I just had to buy, a new oven for my company, or whatever the case is. So yeah, trading is a business. You can frame it exactly in those words. And Jerry says, hopefully my future retirement. Yeah, absolutely. Trading. I've worked with a lot of traders that do engage in the trading environment as a retired after their full-time job. So they take their money, they take their time. And my dad actually got involved. That's how I got involved with my dad. In his retirement, we started trading, and all he would do was watch the stock market. So, of course, we would discuss it, and that's what got my interest. So, yeah, my father took that route, trading and investing as a retirement plan. So that's definitely possible. A couple more. Yeah, but Terry says because traders are merchants, just like drug dealers or brick and mortar shops. I can guess, whatever the case is, you're taking inventory, holding inventory, recognizing when you think something is, in a case of a buy opportunity, undervalued, and then selling it later, 5 minutes, 1 hour, 1 day, 1 week, 1 year, hopefully at a profit. So that's business and taking on inventory and recognizing opportunities. Yeah, a couple more. Buy value and turn and sell for a profit, David says. And then, yeah, Cherry says we move products. So very good. A couple things that I've used or framed or heard people discuss is that trading is a river of opportunities. I think Mark Douglas, in his Trading in the Zone book, wants us to think of it in this term. Trading is a river of nonstop opportunities that every single day offers, chances to make money, and the market doesn't care about you. The market doesn't know. It's not trying to get you. It's not out to take your stop. It's just, we frame the game, we frame the rules. So trading to Mark Douglas and other people would be a river of endless opportunities. For me, it's an auction process, but endless challenge of reward versus risk. So there's reward in there, yes, but there's also risk. So we have to temper or balance our activities in respect to this reward component of this, riches and money and so on and so forth. It's also a performance art. You don't see it discussed in those terms. Mike Bellafiore, Ari Kiev, and some other psychologists or traders do reference performance or sports. I like to use it as a sports psychology. It's in those terms, competitive sports, which means breaking down into component metrics or component skills and developing those skills and performance as in operating at your best potential. Music would be another one. Same thing in terms of acting or dance or just anything that is performance, which is taking a skill, developing and mastering that skill individually, and then doing that in the environment. To me, it's also, which an auction process, a numbers game of probabilities. That involves statistics and risk reward and all these fun things that aren't really great to talk about in a webinar, but that's what it is. It's a statistical numbers-based game akin to poker or gambling or roulette or those games in Vegas where the house has an edge, the players are at a disadvantagement edge, and so the money typically flows over time, not on each individual spin of the wheel or flip of the cards, but money will flow over time into the house and away from the traders or from the players in this sense. Also, this is what I had to deal with as well. I think most people go through this process. We see fear as this threatening, terrible, bad thing, and it's not. At least it shouldn't be framed that way. It's natural, it's normal, it's biochemical. It's just body processes when exposed to an unfamiliar or frightening scenario. If you go in the wilderness and see a bear while you're camping, you're probably going to feel those same things. It's not a bad thing, it just happens. It's how you frame it that makes it good or bad. For example, fear, or just heightened attention, of your heightened state of arousal, focus it toward excitement. So it's the same principle. Excitement, focus, and away from fear. You're feeling the same biochemical responses, the release of adrenaline, all those chemicals that go through your body, how you start to shake, maybe quiver or sweat or whatever else you do with fear. But that isn't always bad. It can also, actually it does, the same coin is increased attention, increased focus, increased concentration, which we call this the fight or flight syndrome. So that helps you run away from the bear. If nothing happened, the bear was chasing you. If your body didn't give you increased adrenaline, increased blood flow, increased brain concentration, that would be a bad thing. So fear in this case is actually good in a sense. Did you know that you feel the same thing and the body goes through similar chemical processes when you are on roller coasters, when you're giving a public speech, when you're performing some sort of athletic discipline, particularly at the Olympics? Not that most people have done that, but if you're performing at that level, you're going to feel fear, I would imagine. Not that I've done that. Or live music. I have done this. I've done public speaking and roller coasters. I know that these sort of chemical responses are framed as positive, good things that help us focus, to concentrate on our task at the time, or to enjoy thrill-seeking. I had a friend that went skydiving last weekend. That's something I would never do, but he did and he loved it. So to me, that is an absolutely terrifying thing, jumping out of a perfectly good plane, but to him it was just the funnest thing in the world. So exact same activity, exact same stimulus, and exact same biochemical responses. He loved it. I hated it. For me, I like public speaking in terms of trading, not in terms of something else, but when discussing trading, this is fun for me. I enjoy it. Anything else that makes me nervous, and I'm pretty sure a lot of people would not even like talking about trading in a public environment. So that's, again, just the point is we're feeling the same thing. It's just how we interpret it is what's important. To me, again, trading is a competitive performance discipline where it can be broken down into component skills, which again goes back to recognizing and analyzing and entering a trade, sizing a trade, managing a trade, exiting a trade. All these things are component factors of what we do. I think it's important to shift from certainties to probabilities. So this is putting it in terms of numbers. It is not a game of prediction. It is not a game of this will happen. If anybody tells you I have the secret, or Google's going to this, or Apple's going down to that, or whatever the case is, or the S&P will collapse and fall to zero, and whatever the case is, let's just go ahead and do your own analysis. That's probably not going to happen. It's just probabilities. It's an environment of uncertainties with probabilities, using historical correlations, historical patterns. Bull flags tend to form this way. They tend to resolve this way. Head and shoulders, things we can quantify and can use past performance into the future. 80% of the time, this has happened when this occurred, and so on and so forth. So that's what trading is. If you seek perfection, which is that go to all these webinars and go to read all these books and learn about all these indicators, unfortunately, the result is you probably won't trade. And I got caught up in that too in pretty much 05 and 06 in the sense of just I have to learn everything possible, or else it's not going to, I have to know this and this and this. It was good for broadening my horizon, and I don't regret that. But in terms of trading performance, I typically focus on simple things, and it wasn't complicated. And I won't make fun of any strategies, but complicated strategies or methods or indicators that helped. It was just basically focusing on, as mentioned earlier, auction process, price behavior, supply demand, and historical probabilities, which is just patterns. And it's not that much different than just price itself. Indicators are helpful, certainly, but if you can focus and tap into price, and by that we mean the aggregate supply-demand differential, that's, I think, what successful trading is. A trade seeks simply this: a higher probability outcome, which is math or stats, A over B. A will be a winning trade over B, a losing trade or a losing outcome. So the market holding support versus the market breaking under support, in that sense. A trend continuing versus a trend reversing. So it seeks a higher probability event, and the combination of more profit gained from a winning trade, which would be A, when the market held support. Then, and say it trades up 5, 6, 7, 8, 9%. Then, or S&P points, from a loss where it moves down 1 or 2% and we take our stop and shut the trade off. So if support holds, it should hold, given that it's happened 3 or 4 times in the past. If it holds, we'll make $1,000, depending on our account or something. If support fails, we'll go ahead and lock that loss at $200. That's it. Period. We'll move to the next trade. So that's how trading is a game of probabilities, where we have this paradox, and it's this paradox of certainty, quote unquote, from uncertainty. And we're referencing a distribution. Anybody who does the normal distribution or bell curve, some trades would be really, really big trades. Most trades would be centered around this little bit won, a little bit lost. If we can cut off that large losing tail distribution, we can shift our entire account to the right, which is profitable. So that's what we're trying to do. Simply this chart. Whatever you do, whatever strategy that you use, whatever method that you gravitate towards, part-time, full-time, intraday, swing position, or for that matter, fundamental analysis like Warren Buffett, whatever that you do, you're seeking an accuracy edge. Greater than 50% chance of a winning trade setup. Let's base your strategy and your setup, method, indicators, whatever that you find works for you, and has an historical edge of more than 50% chance of winning, and a monetary edge, which is gaining more money when right. So if the trade works out, not saying you are right, but if the market does hold support, or if you're betting on resistance, breaking through resistance and continuing to trade higher, then when wrong, which is a trap scenario, or failing at resistance, whatever the case is. It just means taking a small stop and playing for a larger target. That's it. That simplifies trading into a component or a much, I think, simpler environment, just playing for a greater than 50% chance of a win in the context of if this trade occurs, as historical probability suggests, we'll make more money. And over time, over a month, over a quarter, and hopefully over a year, doing this consistently without getting trapped up in taking smaller profits, sizing too small, over betting and sizing too large, whatever the case is, doing some sort of behavioral, put it that way, behavioral deviation from your plan, doing something you're not supposed to do based on your plan, that tends to lead out to success over time. If fear is a really, really big issue, and if you're just having a lot of difficulty with it, and that's fine, don't feel like you've done something wrong. One of the things that helped me, or helps people in general, is this concept. It's called stress inoculation, or just inoculation in general, just like a shot. Getting a shot for measles or the flu, some sort of inoculation shot for that. So getting a little bit of the virus in you so your body can build up a defense against it. So in this case, mental imagery visualization. So picture, and it can be fun with this, picture the worst case scenario for the next trade. What happens? You take the trade, it goes wrong, you've oversized, you don't take your stop loss. What happens in that sense is that you lose a lot of money. Well, then your wife leaves you, the dog runs away, your house falls in, whatever, something silly like that. But that's not going to happen. But if you can imagine the worst case scenario, you start to realize, okay, well, there's more important things than losing money. How you feel, what will your body do, how you react. Will you close a trade? Will you jump up and down and scream? Will you throw the monitor across the room? Will you throw the keyboard outside the room? Will you go for a run? What happens? What do you do? The more you do this, the more you imagine, you'll react better. If you really put yourself in the scenario, you'll be able to react if it actually, which sometimes it will, if it actually happens. If the trade turns to a really big loss, you will have taken your stop without hesitation. You will have known what to do and focus on that. So it's just basically a vaccination is what it is, an inoculation against a really, really bad event, having it happen in your mind as opposed to the real world. And planning out the silly things that we do, like throwing a computer against the wall. Think about that. Well, okay, I have to buy a new computer. So, if that's the loss is a little bit, throwing a computer, throwing a monitor, it may feel good temporarily, but you've got to replace that. So extra money out of your account to do that. So positive or winning, this is the opposite, which is using mental imagery in a positive sense. This is imagining the best case scenario, in which case you make a, maybe not so much a really powerful trade, but a series of really good trades in a row, and maybe for the week or the month, and you're handily beat your goal for that month. Okay, well then you're going to go and take a vacation, and how you feel. You'll take your family to dinner, buy a new car, whatever you want to do. But the more you visualize this, it will help you break through psychological barriers or blocks to help you move towards something. And I found this to be true in my life too, in terms of goal setting and motivation and getting things done. It's often better to be moving towards something than away from. So when I left Huntsville for Los Angeles, it took me, like I said, 3 or 4 years to get the courage to do that. Part of that was what am I giving away? I'm moving away from this and my family, my friends, the cost of living and traffic, and I don't want to do that because it's comfortable and it's happy here. I don't want to move away from this. Versus moving toward, which is what will my life be like? Who will I interact with? What will the things I'll be able to do? What kind of concerts? What kind of fun things? What kind of professional things? What kind of opportunities? And all these things. So in trading, the same thing, or anything in life for that matter. If you're having trouble making a decision, trouble making a trade setup, trouble being consistent, think of what you're moving toward, which is your successful retirement, which is going from part-time trading to full-time trading, or going from a hobby to a career, whatever the case you want to do, from a tyrannical boss and office politics to an entrepreneurial business. So whatever you're doing, move towards something, not away from. That helps. Another scenario to help you, or strategy to help you, would be, and this helped me too, it sounds silly, but it really does work, time the episode. That I mentioned fear is a biochemical body response. So for a specific event, especially during a live trade, when you're managing, sometimes some traders don't have a trouble putting on a trade. Sometimes they have a trouble managing an open trade. This is what we're talking about here. When you're in a live trade and you're fearful and you're sweating and you're shaking and whatever the case is, literally get a stopwatch, use your iPhone, use your whatever you have, and time it. Seriously, time it and write it down. This particular instance lasted 3 minutes. This one lasted 3.5 minutes. This one lasted 5 minutes. What's nice is that when you're in the moment, you're caught up, and fear is a very narrowing emotion. It narrows opportunities. It focuses your attention on one thing, which is particularly getting out of this bad scenario, running away from the bear, whatever the case is that you're fearful of, stopping the trade. If you stop the trade, more than not, that fear goes away. But that won't get you trading success if you consistently stop trades as they're taking place. So it doesn't last forever. And what's nice is if you journal them, keep them on a particular page and look throughout your journal, you'll find that, A, it helps get your mind off of this fear and off the market, off what's happening, and you'll see the trades or particular fear events, they diminish. They actually decrease in time, and so you'll be able to focus on that. That's if you have a chronic, chronic fear stress response, and that does happen. We're all built differently. Some people just really they feel or experience fear differently. We're talking, if this is applicable to you, this is a strategy to do. Not everybody has this happen to them. Other ones, now we're talking biochemical, talking what we can do physically. Let's talk about what we can do in the market. So if we're talking strategies for overcoming fear specifically, after a series of losses, we simply enter a slump. One thing we can do, which is nice for the Big Mike Trading Forum here, you have each other. You have Mike. You have a group of traders together. You can talk about this. You can explain this. You can, I hate to use the word complain, but that's, you can share your negative emotions. Oh, this market got me today, and oh, I feel bad. And people can say, well, this is good. I've been there, and let's, work through it together. So that helps you too, just to be able to work with other traders, and you have the group already built in for that. Stress and fear, it's triggered by, really, a feeling of being out of control. So, the market's going to get me. The market makers, the high-frequency traders, are just random. I don't get it. This indicator works sometimes it doesn't, and this market just won't fall. The market won't go up, whatever the case is. So you're feeling out of control. You don't have a plan. You don't have a strategy. You don't have that method, and, yeah, it is overwhelming. It is very overwhelming at times. Even as a professional, the market can still feel out of control at times, particularly on Fed days or high volatility sessions. So what we do, we step back and regain control. We pull back the perspective. We widen or broaden our options. To do that specifically, we can reduce our trading size. Not because of fear, but to get back in this control sense. We just basically reduce size. That inherently reduces stress. Notice we're still trading. We're not just walking away and going away for a week or something. We're still trading with less size. Can also reduce strategies or indicators or methods, setups particularly, to only the ones that work best. It's helpful if you quantify or track your trades, and there's software to do that, or just Excel even, to find out I'm better as a retracement trader, I'm not good as a breakout trader, or whatever the case is. Track your best trades and focus on those when you feel this is happening. And it's just a slump, essentially. Reduce the markets, if you're trading oil and gold and currencies and Forex and leading stocks, all that. Drop down to 1 or 2 or 3. If you're a stock trader, focus on the stocks that have made you the most money, that you're most consistent on, and just focus on your strongest markets or stocks. Don't feel like there's 500 stocks in the S&P and 2,000 in the Russell and all those kind of things. I've got to find the perfect stock and all those kind of things. Just focus on what's working, what's been working, until you feel like you've got back in control. That's what it is. Get back in control. Reduce size, reduce strategies, reduce markets. Before we go, let's go ahead and together discuss a strategy to simplify your game. This is just a quick 5-second, back of the envelope calculation, but it can work more than anything else sometimes. Just simplicity actually does work. So frame your trading as a numbers game where you create your own rules. You create the rules. You empower yourself. You set boundaries. When I will trade, markets that I trade, setups that I trade, and what are your goals? Build backwards from your goals. If I want to make $1,000 a week, you can do that in terms of S&P points per day on average, or dollars in a particular stock per day, or option contracts, whatever that you do. Set your goal, build back from the goal, and you'll find out that I need to make X number of dollars, X number of percent, X number of futures contracts points. That helps. Start with a basic setup, master it, and then add to it as you get better, as you begin to increase. For example, I know it's a lot of text, but just kind of going with me. What you're doing is just framing your game. The market is your world. The market is your world. And there's a lot of things out there. Think of how many countries there are in the world. There's over 200 and so countries in the world, but if you focus on 3, 4, 5 of them, etc. Same thing with stocks or markets, ETFs, options, so on and so forth. The charts are your playing board. The game pieces move around, and you're setting up the structure, the rules, and all that on the board of your markets. And the indicators, Elliott strategy, Fibonacci, whatever that you do, moving averages, etc., trend lines, they're the tools. The chess pieces, the checkers pieces, the pieces on the board of the game of Risk or Monopoly, all that kind of stuff. Those are the tools that you play to find opportunities, to really risk capital and put your hard-earned capital at work within these parameters. Simply, and notice, focus on this right here. You determine. You determine. You determine. Criteria, what you buy, how much, targets, stops, loss. Here's the goal. You. You're empowered. I think a lot of it is empowerment and focusing on what you can control, what you can manage, and the outcome is uncontrollable, but you can manage how much you put to work. You can manage when you enter, when you exit or sell short, how much, target, etc. You're in control. So just summing up, going back to what we talked about earlier, for that simple retracement game, notice I didn't call it a trade, call it a game for fun. Look for uptrending stocks, for me maybe strong sectors, with increasing volume, simple to find. Find a retracement trade, which you can quantify that, but just say a retracement down to the rising 20-day exponential average. This could also be a Fibonacci level or a trend line or something else, but just this is variable. You can do whatever you want to at this point. It's your game. Buy on the touch of the rising 20 EMA, which is price-based. So you can do this, again, Fibonacci or within 1% of the EMA, whatever. Keeping it simple is just basically touching it. You're going to target the prior high on the uptrending stock and place your stop 2%, maybe 1%, maybe 1.5, whatever, under that 20 EMA. Hold the trade, overcome your fear, do those steps, journal it and do your positive visualization and stress inoculation and, all that until the target or the stop is hit. When you're learning, it's best not to adjust. As you develop, become more professional, yes, it's allowed to adjust trades. You can say, okay, well, I thought this would happen, now it's not, so the real-time situation is changed, but when you're a new trader or keeping it simple, that just focus on stops and targets and trade that. You're building your goal really isn't money at this point, it's to put trades on and manage them appropriately. That's a building block for success. It's nice that when tennis players, if they miss a swing or if they miss the ball or hit the ball out of, golf players, all that, they hit the ball out of bounds, they're learning, they develop through their losses. But as a trader, it's more difficult because we actually lose money if we have an outcome that isn't favorable. So, think of that just the same way. Again, framing it, the person buying the new stove, buying the warehouse, buying the thing in the business that they need to expand their business, that's what a loss is. It's swinging the tennis racket and missing the ball. Darn, I won't do that again, that kind of thing. So exit at the touch of the prior high or on your stop. That's it. No management. Just set this up and let it go. A couple of examples from Amazon. As it was trading up, trending up, this is last year, going into this current year, So we have this pro trend. It was a leading stock. And in this case of the one, stronger volume was about November. So what's happening here? We have a touch of the rising 20 EMA. First off, higher highs, higher lows defines a trend. Rising moving averages define a trend, and higher volume typically defines a trend that favors continuity. So we'll simply enter at the touch, which is quantifiable, exit at the high, also quantifiable, and we're done. That's the trade. This is, again, building success, playing a simple game. You can build upon it later. Second example, volume wasn't quite as strong, still stronger, at least. The green is the buy volume, touching that moving average just about, and trading up to the high. So two examples of a successful trade using these simple parameters and jumping into that a little bit closer. Same thing. There actually were two spots in November where Apple, I keep saying Apple, I'm trading that today, where Amazon was touching this rising 20 EMA, 1, 2, and you're buying at that. Simple. You have a fixed game plan, a fixed strategy, and you trade that. The stop is 2% under. At that case was about $5, which is here, 340, just under 340, and the target's the prior high. So you're playing for a $5 thereabouts stop. You're risking $5, 500, 5,000, whatever the case may be, and you're playing for a $20 target. That's a fourth one. That's ideal. Will be every single trade, but just keeping this as an educational example here. Same principle. Touch to an extent, and then 20 up, 5 down, 4 to 1. So just playing that over time, that is successful, assuming the trend continues. If the trend reverses, you're taking your stop. So finishing up, the 3-factor plan for trading success, going back to what Mike said, it's the indicators, it's the strategies, it's what we do, it's the methods, knowing what to do, finding trending markets, finding retracements, finding breakouts with high volume, etc. Doing it, which is not getting caught up in this sizing too small or waiting for that perfect setup. Let's go back a second. I did this on purpose to show you that this wasn't a perfect setup, right? The stock didn't quite touch, Amazon here did not quite touch the average. It came just a little bit close, but the principle's the same. So that's reality is that more than not, a textbook example is one thing. The real world will not be perfect. It's essentially doing it in an environment of uncertainty and managing your results going forward. And then adapting to changes, which that's a whole other webinar. So, and that's just respect to trend and volatility for the most part, and narratives driving the market. I discussed that on the prior Big Bank webinar too, just adapting and game planning. So that's in the archives there for you. Clearly define your strategy, which is this. Just focus on these two. So that's be simple, be clear. Don't just jump around and say, well, Elliott didn't work, so I'm going to abandon it. Fibonacci doesn't work. Trend lines don't work. You know, moving averages, whatever. Volume is ridiculous. I had a big conversation with that about a trader recently. Volume is completely irrelevant. We can't use it anymore for the rest of our life. Well, you know, that whatever the case is, I won't go into the debate. But the fact is, define your strategy, define what works, define what you understand, and then put that into practice. And this is basically this. I would write this down. Define what you trade. That's your global markets, Forex, options, futures, and the time frame too. Intraday swing, 5-minute chart, hourly chart, daily, weekly. And focus on those. What creates a setup? You know, retracing to an average. Breaking out of a triangle, breaking down a neckline of a head and shoulders pattern, and of course how to enter and manage your opportunities. This is all from my experience working with traders as a coach or just as other colleagues. This does help you reduce fear and increases the odds. It builds success. Part of this webinar is building success. All this builds success. It builds confidence because you're knowing what to do, and all your job is at that point is to act on it, to do it. So you're not worrying about, well, this may happen, this may not. Sure, it may or may not, but your behavior is if A happens, which is if a retracement to an average or a support level or something, I will put the trade on, put my stop here, put my target there, and then you'll act on it. For me, if you write this down, write down what you're doing in the evening, particularly if you by hand. A lot of that research shows that doing things by hand is actually preferable to doing so on the computer, but that's, you know, I've always done that. I've written by hand. That helps a lot too, just in a journal and a trading notebook. So that helps you define And what you're doing in the case of the actual real-time market is putting on these strategies. But if strategy isn't enough, and I understand that it's not, I get that, it happens. Particularly even professionals go through slumps. This is how we overcome those. If you're still having trouble, simply reduce your size. Keep trading. Keep building success profiles. Reduce your size. Reduce your setups. Reduce your markets. And trade this, I like to call it back to basics. I did a 4-hour course on this concept of back to basics at an expo a couple of years ago, and I'd like to do it again. It's just simply going back to what works, going back to what's simple. Cutting out all this fun things, but just getting back to what works. It's basically Dow theory and market profile and some Schabacker, Edwards and McGee, price patterns, so on. It's price, supply-demand differential. To me, it's market profile concepts. That's what helps me. It's just thinking in terms of probabilities and just keeping it simple. Use a stopwatch method, stopwatch and journal. Again, going back to writing things down. Use visualization techniques and mental rehearsal, both in a sense of what to overcome or inoculate against negative, losing, how you behave, how you react, what you do, and winning or positive, which is this is going to motivate me to put this trade on. That helps too. And breathing exercises, didn't really go into that today, but this stress, breathing exercises is important. Exercises such as yoga, we don't see most guys doing that, but that can help. It's just stress relief, all that kind of things. There are a lot of techniques that can help you with just breathing, centering, refocusing, all those sort of things, meditation too, and then working with a coach, working with the forum. Here at Big Mike, you have, again, other traders to work with and to interact with. So that is definitely something you can do. And to receive the slides, I think Mike said this will be rebroadcasted tomorrow. You'll have the archive there. Any questions? We'll take a Q&A now. Whoops. Any questions in terms of this, Corey at afraidtotrade.com. You have a free 2-week trial if you're interested. Just learning more of what I do. It's this, game planning, same thing we did last time. This is more psychology, but my strategy is all that. Plus 2 lessons is at this link. It's premium.afraidtotrade.com and just /Big Mike. So it'll be there. And just everybody's welcome to try out the ideas here. No credit card required, no sales. I'm not a salesperson, just a trader like you who enjoys market analysis and market trading, and for me, discussing psychology. It's kind of fun for me. But yeah, so that's what I have. So let's go into the questions. And again, if you have questions offline, it's Corey at afraidtotrade.com.
All right. So thank you, Corey, very much, as always. So, guys, if you have questions, you can go ahead and type them in. And, Corey, I have a few of my own.
Yes, go ahead. As the traders are coming, go ahead. Let's go.
Have you ever read the book by David Aronson called Evidence-Based Technical Analysis?
No, it's on my list. I have so many books on my list, but okay. That's one I've not read, actually. I hate to say I haven't, but I know I'm familiar with the book. I've seen the title, all that, but I've not read the whole thing.
Okay. I really like the book. It's one of my favorite trading books that goes into patterns, okay? And because you were talking about patterns earlier in the presentation when I wrote this down, this question down. But one of the things that I've noticed a lot of people tend to focus on is when you see a pattern forming and you're assigning some kind of predictive value to what is likely to happen because of the pattern. But then as time evolves and the pattern ends up not materializing, people very rarely, like extremely rarely, will ever refer to it as a failed pattern, like a failed Head and Shoulders. Instead, it becomes a whole new pattern that you should have seen all along. It just magically morphs from a Head and Shoulders to something else, and people tend to discount or disregard or just forget flat out that they were calling it a Head and Shoulders only days before. Anyway, I was just wondering if you had read that, because it applies to what you were talking about, some of the patterns. Deb's asking. It's called Evidence-Based Technical Analysis by David Aronson. Yeah, go ahead, Corey.
Oh, this is something I do a lot in actually a lot of examples on this. I can show you multiple examples. That is a wonderful question. I've actually given presentations on this exact pattern here. When the market was just going back with me on time, going back to, March 2009, the bottom, this ABC wave up. You had all your Ellioticians saying, oh, there's ABC, we're about to go down for a third wave, and there's the fifth wave. multiple divergences in momentum and in volume, and this is that pattern with respect to this head and shoulders. Jim Cramer, of all people, in the blog world, every single person I remember was talking about, oh, there you go, head and shoulders, S&P breaks 875, it's over, we're testing the lows, or at least going back to target the price, the head and shoulders pattern, just project the neckline to the headline, the neckline from the head, project down. It's about 830. It wasn't the end of the world, but still. Anyway, what happened at this juncture, and you can see it here, well, given in the future, but everybody can see the chart with me, right, in terms of trade station here. So that's the initial break, pure price. There's 1, 2, I think it stayed, the neckline is here. The market stayed about 3 or 4 days underneath the neckline, and volume was, quite high. This is a distributive or distribution pattern. What happened? The end result was this. There's your quote-unquote stick save or short squeeze or failure. This pattern failed. There's no other way to talk about it. This is a failed pattern. One thing I love to do is talk about that. It's this concept of patterns, or if the market should do something, but it doesn't, it typically leads to a larger than expected move in the opposite direction. So the end result of this, and I believe that's predictable, not predictable in a sense, but probabilistic, that if a very widely followed pattern fails and it goes back and it triggers these stop losses, you can almost quote-unquote predict. You can trade. You can't predict. You can trade the outcome, which is a big, big, big move the other way. And it was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and even beyond that, of a failure of outcome. That was a brilliant event. I would recommend everybody go back and look and study this pattern. The similar thing happened in a broader sense in much broader, 2010, when you had the exact same thing happen. It's this case of this failure patterns, left shoulder, head, right shoulder, break of the neckline, power rally up, retest, and the end result was this, boom. Anyway, the point is, these patterns, don't reclassify, don't call them something cute or gloss over them. It's a failure, and that's from a market profile type of concept. You've triggered a lot of people short, which makes sense. That is a short sell signal in this event, both events or multiple events. Bears or sellers will come in, but they will also place their stop losses above either A, the breakout, which is this 890, 900 area back then, maybe above the prior high, 925. Those are the aggressive bears. Oh, I'm going to take a really big stop loss. Maybe even above 950. Well, as the price pushed up and triggered all of them, notice that these big bars are the result of pop stops, as we call them, short squeeze. So I would say that failure patterns, when they occur, tend more than not to lead to bigger moves the other way. We don't redefine those. We just call it for what it's worth. It was a valid signal at the time. Buyers in a probabilistic or auction process or whatever, they stepped in, overcame the sellers, and the end result was a short squeeze. And that happens a lot. Happens a lot. Traps are quite common.
I wanted to ask about the importance of statistical gathering in terms of like looking at the chart that you're doing right now. People like to go back and look at charts and find patterns and find signals, and they make notes, and this crosses that, and there's divergence there. A lot of people spend a great deal of time on this, but I see very few people do any type of statistics on the actual execution of their trades, like the analysis on what they did with all this information. So they spend, 2 hours a day poring over charts and making notes and doing all this. And then the next day they make 5 trades, and they spend exactly 0 minutes reviewing them for, how it lined up with what they were studying all this time. I mean, you mentioned that you like to have a handwritten journal, but I mean, just when you're looking at this, the big picture, do you see this a lot on your side, or is this only me? Am I the only one seeing where people are not spending the time to review the actual executions and look for patterns within themselves? Are they doing well?
Yeah,
are they
definitely.
doing poorly? Are they following the plan? Are they completely random? What are they doing?
Yeah, a lot of it's the payback payout cycle, essentially, is when you're in a zone, and this happens a lot too. What I do, I just got a lot of time on this. What I do, one thing that helped me a lot was going from over-reliance on stats to patterns. So it's things that I do in the idealized trades, and I've been doing this privately. The blog was when I got started doing that, but in 2007 and forward, is taking the trading session. Here's an example I think of yesterday's, but this is a, it's taking a, this will be an example here. I'll just pull this off on the SPY and looking at what was logical. For example, just taking it left to right, the short sell triggered into 187, into an upper trend line, and the market moved down. Here's your trend line break. Here's your resistance. It's a short sell. Number one is a short sell, basically. The stop is above. It didn't work. It's a failed pattern. So it led to the same thing. If the market should have traded down, big move up. So if you're not going to see that, what you learn from this, what I learned from this, doing this every single day, is how the market changes and adapts and how you particularly respond to the trading scenarios as they change. And it helps you see it visually. So your execution, did you get in at we call this efficiency planning. Did you short at the trend line, at the break? If not, what made you not do that? And that's fine, but it's testing out what theoretically was perfect and your distance or closeness to that quote-unquote theoretical perfection. And management. So this trade failed. The market did not go back down. It had this buy rally that popped the stops. So the short squeeze, same thing as we talked about earlier. And so that leads to a second entry, a very aggressive entry to play. You're still going to lose money. That's not fun. But you play the breakout. So same principle. Did you execute at the breakout? Did you wait? Did you, even not execute at all? And the same other trades were based on this before. So that's kind of it. I would recommend taking it away from, a lot of people do this. They take their journals, they take their trades, and if they do that, if they quantify their method and what they do, they don't do it pictorially or visually. So I recommend things like that, which is actually drawing and connecting what your entries, what your exits, what your adds, or reduce positions, half off or something, to the actual chart. So basically put your stats visually on the chart, and it's going to tell you things that the stats won't tell you with respect to, again, what we call efficiency. Given the perfect entry, which no one's going to get that, that's not your goal. Given the perfect entry, were you early? Were you late? And that's going to help a lot too, just is putting your stats visually, pictorially, over an end-of-day analysis on whatever that you trade.
Yep.
That helps a lot too. And yeah, execution comes out. We can see patterns all day long, but it's what are you doing? Are you early? Are you late? I think that helps a lot. It's the same thing with exits for that matter too.
I see one other thing I just kind of comes to mind right now is when people are studying charts or when they're posting charts in their journals and stuff on BMT, and there's literally like hundreds and hundreds of journals on BMT every day, and they're great.
Good.
But one thing that I've noticed that's in common is probably 5%, maybe, ever talk about the hard right edge. It's always screenshots of past setups, and then they mark them up, and that's great. That has some use to it, but that's not what you're dealing with at the time that you place the trade.
Exactly.
And it's so hard to train your mind. The visual component is such a key component that if you're practicing every single day, and it's like an entirely different game, because what you're practicing, you get to see what happened later, because you got to see that it worked. And it's so much more important, in my opinion, to practice right on the far right, the hard right edge, because that's where you're going to be living every day. That's where you're going to be making your money. You're losing it. Anyway.
One tip, very good. One tip to do, and it's so simple, but I don't see hardly anybody do it. It's just this: if you're playing a breakout scenario, this is intraday or whatever the case is, and the market's this is so common. The market's at the highs, testing resistance, but then it breaks above it, and you're trying to play a breakout. Again, visualization. This is happening in real time. So you just take a little screen and size your chart and pull the chart and have visual open air. So you can, okay, well, it makes more sense now, right? If you can see the market moving up and having visual air.
Right.
Sometimes you can see it now, but do the real-time market.
No.
I know, right?
I know exactly what you mean.
If you just pull this and say, Same thing when the market. Okay, when the market broke out this morning, and it broke to new highs above 18. Take the Fibonacci off, but when the market broke out this morning, and we say, oh well, it's how common, it can't go any higher, and da da da. If you had just taken this and pull the chart down, right? I mean,
It can go
it's
a lot
something as
higher
simple
now.
as that, and it's
Yep.
real-time management.
Yep.
Yeah, and another component is that moving averages and momentum and all these indicators are going to be just a little bit different on the right side of the chart than the left. So you have to actually kind of draw, if you will, when you're. I know we can't do it now because the market's already done, but if you're doing this from an analytical standpoint in real time, or swing trading for that matter, take the right side of the chart off and then draw your indicators up. More than not,
Yep.
they're going to continue.
Yep.
So like that, the moving average probably is going to keep going up. The Bollinger Bands are probably going to keep expanding, and so on and so forth. That's going to help you get a sense of the market if you just do that. So
Yep.
that's most people do that, but it's not that common. But I think if you actually just extrapolate, things get better, and that's pretty much what happened in the market. These averages kept rising.
It reminds me, a couple of years ago, there was a discussion about the right margin on charts. Like I personally like a lot of right margin, the empty white space between the last bar and the price, because I like to visualize what's coming next, kind of like what you just did and snag it, So yeah, I totally agree with that. All right, guys, let's see if we have any other questions. Yeah. Which one were you going to go for?
Terry asked a question. I was going to Terry real quick, just continue the thought. Terry asked, should we take a screenshot of the entry and exit as it happens so you can see exactly what you were seeing? Yes. When I have clients that I'm working with on a one-on-one basis, that's exactly what we'll do. We'll have them take a look at the chart. They'll send me what they did, what they saw, and do this on your own time too. If you're trading, hopefully not 10 or 20 or 30 times a day, but if you are a part-time trader, you might take 3, 4, 5 trades a week or something, or 1 or 2 per day. Yes, print the chart out as it happened in real time. Print the chart out also, or keep it in a file to actually print it, but it helps too. Keep it in a file when the trade's exited. Then go back and look and do this hindsight stuff. Do this, oh, well, there's this touch this and this, whatever your trade components were. How close were your actual fills? Your fills, maybe there's some slippage sometimes, to what was quote-unquote ideal or perfect at the time. And more than not, by doing that procedure, you'll bridge the gap between your what's called efficiency. If you're entering way too early, jumping the gun, it happens too, or exiting too late, letting the market push 3, 4, 5 bars up off a support level, that's inefficient. You may still make money, but there's 3 or 4 S&P points or Apple dollars, whatever, that could have been achieved. So yes, print them out both as you execute in real time and as you exit, and at the end of the day. There was one more real quick. Any other thoughts on that, Mike? That was a
No, I agree. There's a couple of good questions here too. Andrew says, hey, some people who claim to be profitable say that trading should be boring. What do you think?
I've had that talk with a couple of colleagues. If trading to you it's a good framing the game, I think it's fun, it's enjoyable, it's a big challenge, it keeps me interested. I've had it where it's boring. I don't like that as much personally. But with respect to the argument that trading should be boring, with respect to you have a particular set of rules. For example, you're going to watch the market touch or test a moving average and nothing else, or form a triangle and break from the triangle, or break to a new high, a new 52-week high, and then get long. That's all that you do. You don't go and look at, plug, P-L-U-G was pretty interesting the last few weeks and months and so, but you don't look at that because that's not your world. Your world is the S&P futures trading triangles, and that's it, nothing else.
Yep.
So, that's the argument there. I think it's more fun. I think interaction.
It's like you said at the
sharing
top.
victories.
It's a business. It's a business. I mean, you don't want to dislike it. That's obviously important. But if you're if you're having some kind of major thrill or major blood pumping rush every day, then probably it's not good, because you're probably trading too much size, or you're too worried about a position or something. It should just be an everyday business. You enjoy waking up, you enjoy going to business, going to your business and going to work, and you like what you do. But for me, it's this kind of uneventful, and that's for me, the way I make it eventful is with all my statistics and my spreadsheets and my graphs and my all the stuff that I do away from the charts. And try to get the best portfolios, and that's what makes it fun for me, is that part of it. Clicking the mouse and going along is not very much fun. But, the rest
Yeah,
of it can be
exactly.
fun for me. Ciro has a good
Well, the
question.
components. Yeah, components. Yeah.
He says, hey, everyone speaks of having an edge, but he has yet to see something that gives you a real advantage. Do you know of anyone that actually, do you know of any that actually give, whoops, any that
No,
actually give a real advantage? And I see this question in various shapes and sizes, so take a stab.
you want to take it first or me?
No,
This is a big
no,
one.
yours, all yours.
Okay. I think in terms of principles, in terms of indicators and methods, no. I don't think you can take a stochastic and pop it on your chart. Next, you get an edge, that kind of thing. I think edge is both technical, which is there's a trend. I think edge comes from following a trend because in general, trends once established have greater odds of continuity than of reversing. So if you are trading pro-trend retracement strategies, those tend to test out better trend following stuff over the course of time. That is, not every individual trade, than not. Trading the exact same breakouts or retracement for that matter, when confirmed with higher volume, participation, momentum, market internals, tends to test out better than those that occur on lower volume, lower internals, divergences on momentum. For example, today's session, going back to that, had a breakout to new highs. Yes, that's a factual breakout on the 1 minute, 5 minute, so on and so forth, S&P. But if you look at momentum and internals, particularly, this is tick, I use tick, what was going on? Just screencasting this, this happens all the time. You have your tick made its high over here on the prior session. That's yesterday's session. The tick high at the open was here. It actually went down. So tick was making, with the exception of that one little push there, so was momentum. So trading this retracement on higher momentum and to an extent higher tick was greater probability than trading this retracement on lower tick and lower momentum. So that's factors like that. I would say trend, volume, basically trend and things that confirm trends for me are edge. And somebody mentioned it. Terry said, yeah, the edge is just your plain gray matter. Exactly. I think, honestly, that is all things being equal, not to be whatever, but we all see the same thing. We all see, for example, that breakdown. Let's put it that way. The breakdown in the head and shoulders. In 2009, the breakdown, the little fair things happened recently. It's how you react to that. If you say, darn, they got me, oh, I hate it, it's awful, blah, 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 I hate this thing. Well, that's clearly you taking the exact same setup and losing money, or someone taking the exact same setup and losing money, but getting long, realizing supply-demand shifts, not taking it personally, having gone through this and trained and have experience and the ability to step aside and say, oh, okay, well, it's just probabilities, not personal, and generally, if a really obvious outcome fails, it typically leads to a larger than expected move. So the ability to take that same entry and the same exit, but the other trader walks away sad, upset, mad, and the other one gets long and makes money from that. So all things being equal, a lot of your edge is going to come down to yourself. It really is. And how you manage emotion, how you manage trades, whether or not you get upset, whether or not you reduce size in a slump, whether or not, we didn't talk about it, but increase size when you're having success. When your method and your mentality and the market are all aligned, it's trading bigger size in that sense, and of course trading less size when not. So, and a lot more than that. Motivation, discipline, we're all different in that sense. And so, yeah, is there any system? Probably not in an aggregate sense that it's going to give you, every single year, year in, year out, every single trade and every single month. No. But given the same market, the same conditions, the same setups, trading success or trading outcomes can be different, will be different, depending on how we manage, that kind of thing. So yeah, I think a lot of it comes down to, now we're not talking high frequency trading. We're talking just you and I on a individual basis. It's the ability to recognize and manage opportunities, risk, and do so consistently. And I argue, learn every single day by plotting out your charts and plotting out your trades, and right. Every day you get better. So I think the edge, really, the key edge we can build on is our education.
Everyone in the beginning seems to focus on the
Experience.
methodology, and they focus on the indicators and the signals and the crosses and all that stuff. And that's a lot of fun in the beginning. And then they start a journal, which is fantastic. And
Oh yeah.
then if you go read these journals, what you'll find, it's become abundantly obvious to me over the years, seeing, a couple thousand journals, is that if the journal sticks with it long enough, if they don't give up, then they will quickly turn from all the methodology focus to the psychology focus. And I personally subscribe to the belief that most of your edge is psychological and not,
Yeah.
because everything is open to interpretation in some way. Even a line on a chart, it's all open to interpretation. So it doesn't really matter what the technical stuff is telling you. It's a matter of how you interpret it, and then the only way to know that you're doing it right is to analyze your psychology, to analyze what I call looking at the executions and spending all the time on that to see if you made mistakes. Did you follow your plan and all these things? And it's less and less and less reliance on whether or not something crossed a zero line and told you to go long or short. Anyway.
That's exactly right. Exactly right.
Let's see.
Brandon,
Joe's,
a good question. Why don't you jump on Brandon's question? Jessica, go ahead.
let me go back. Which he's
Brandon,
talking about the. Go ahead. It's off my screen.
That's something I don't do. Brandon, I had a great question with respect to taking a snapshot when you put the trade on, when you take it off. He's saying take a picture a week or two later. That's not something I do, but that's something that can absolutely enhance performance, particularly as a swing trader, because you're looking at what if you saw a reversal candle or saw this and got out, and you thought the trade would go higher, and so you take the trade off and you made a profit. Great, that's wonderful. But what if 2 weeks later that stock was 15% higher?
Right.
Or 5% higher? Was that really good? That kind of stuff. Brandon, thank you, Brandon. That's I'm more of an intraday trader, but as a swing trader, that is 100% very, very good advice to do. I recommend that. Yeah.
One of the
It's basically taking a snapshot after a trade's done and a week or 2 weeks later.
Yeah, one of the things that I did kind of similar that maybe will be helpful to somebody is I had a spreadsheet where I would have a column labeled efficiency, and it's not MAE or MFE, okay? It was just basically under the best case scenario, totally not realistic, but if I were to get every tick of that trade, what was my benchmark? How efficient would that trade have been compared to what I actually got? Did I get half of the move? Did I get 70% of the move? Did I get 5% of the move? And that really helps me because these statistics really stick out on a spreadsheet. And whatever, you see that you're only capturing 20% of a move over and over and over again, it can be a real encouragement to do better.
I totally agree with that.
Okay, Joe's asking, when you say place a stop 2% below support, he says 2% of what?
Yeah. In general, the stop loss management can be done any number of ways, but just in this example, to keep it simple, we're just making it simple. It's 2% of the current price. So Apple at about I can say it again. Amazon at $3.45. A 2% stop was about $6, about $5.50 thereabout. Making it simple, it's just 2% of the current price, which is about $5.50. Just as a stop. It can be done, a point, $5 fixed, $3 fixed, or in the intraday world, 1.5 or 2 S&P points. But in terms of percent, if you're swing trading, 2%, 3%, whatever the case, it depends on what you're playing for. Playing for a 6, 7, 8, 9, 10% target, which, again, mathematically what the price of the stock is to what you think it's going to go to and where it shouldn't go to, that's where I'm getting probabilities. It can be also done by ATRs, which is average true range. It's an indicator that just measures volatility, and you can play 2 average true range values down away from the price, or 3 average true range, and so on and so forth. There's really, really, really lots of ways to play stops. In this case, it's referring, just for simplicity, to a 2% of current stock price.
Okay. All right, so since we're running up on the hour-and-a-half mark, I have one final question for you, Corey, that again, I'm just trying to kind of target what I see a lot of people run into as common obstacles on the forum. And one of those is an over-reliance or an extreme focus on win percentage with absolutely no regard to risk-reward. I see all these posts. Hey, Bob and his trading room says he has a 90% win rate, and that's it. It's that's like they don't even consider anything else. They just see 90%, and the blinders come on, and they start salivating. They don't really consider anything. So one of the things that I've learned over all my years of doing this, 18 years, I guess, is that it's so critically important to embrace loss. Don't be afraid of losers.
Yeah.
90% win rate is great, but so is a 40% win rate. So is a 35% win rate. You can make a ton of money with a 35% win rate. So do you have any advice on how this? What has been your experience? What can you tell people? Maybe they'll listen to you.
Well, they should listen to you too. It's sometimes just doing it yourself. A lot of times when I work with traders, same thing. It's just we can tell them, but it's just doing research on their own, learning on their own, etc. Yes, accuracy is very, very sexy. It's very enticing. It's very, very wonderful. But in the grand scheme of things, it is one component, and there's more to it than this, but one component of really, for me, a two-edged factor. So it's basically how much you make. Trust me, I can give you right now, and I want to show this to you as well. I've done a lot of research on this because research is very important too, but see if I can do it quickly in a 5-second explanation. So if you're basically the entry, so stops and targets, so on and so forth, we can make a system that is, here we go. This is a volatility-based system. I won't go into too much detail, but you're playing a profit target of $3. So basically what that's saying is the market, whatever it is, net profit is the green line scaled on the left axis, percent win is a purple line scaled on the right axis, and so what this is, this little thing at the middle, is your percent of stop loss, meaning a 1% stop and a $3 target. Is it the dollar? No, dollar, I'm sorry, a dollar stop loss. So you're playing for $3, risking $1. And this example made $2,000. Great, that's wonderful. As you increase stop, this is what's important. This is, research shows this consistently. As you increase your stop loss, yet keep fixed your profit target, so much so that you're playing for $3 to make $6, your win rate is 75%. And you make money, and this is a random example, but see, as you play for larger stop losses, your win rate, at this case, max is at about 80%. So 80% of the trades that you take win, yet you lose $3,000, and this line goes down consistently. So yeah, this system, we can trade this any day we want to play for $10 in a volatility breakout, play for 3, risk 10, get 80% of our trades to work, yet blow our bank account out. That's just the way it works. So this is what the model shows. You can test this out. I didn't do much time for a quick webinar, but yeah, it goes down to that. It's the duality of this accuracy edge. Oh, by the way, on the opposite side, on that stat, you could have had a 20% win rate. Just flip the chart upside down. A 20% win rate, yet made $4,000 with a playing for a stop that was much smaller or larger than your risk. So yes, it is the duality of an accuracy edge, which is your percent of chance winning, and test it out over time, with what you get when wrong, then right. Hopefully, the best systems are greater than 50, but you can do a system that's 25% correct that wins 10 to 1. And just do the math on that. Every whatever the case is, every 3 or 4 or 5 trades lose, with the one trade that wins knocks out. It eventually knocks out 10 losing trades. So over time, that plays out. Even with a low win, 3 trades out of 4 fail, but the one that fails makes $10. So 10 minus 3 is 7. Do that over time, and there you go. And vice versa. If you have a win rate of 75%, you're losing $10 every time you lose. You're gaining $1. Right. You're going to blow your account out with a 75% win rate. We can make it 90. What about a 90% win rate with a $20 loss for every $1 stop, so on and so forth. You test this stuff out, and it comes up with that. It is a duality. They work hand in glove. Accuracy is only one part of the equation.
Sure.
And in fact, can be misleading, can be actually very misleading.
And Kilgore is actually mentioning something important, too, about using a Monte Carlo sim to help you understand the probabilities, because even with a 50% win rate or an 80% win rate or whatever, people are not set up to understand the strings of losses that you can have and still, over a larger sample of trades, still be within your 50% or your 80% or whatever it is. They just think, oh, I had 3 losses in a row. Something must be wrong because this is a 50% win rate strategy.
Yeah.
So anyway, okay, 2 things. And then
I think I had just on my webinar thing, someone said the access was tonight. Go ahead and click that over there. So yeah, trying the free trial, get the web page to work. So we'll get that to work too. Just one moment. Go ahead. Go to the question of what's happening now. Is the website's open? So that page didn't work. So it's working now though.
Okay, so you want to
have a free trial and can't get into it.
So throw up your contact info, and I just wanted to say, so for anybody that has more questions or wants to email you or check out the trial that you just mentioned, can you show us that contact slide?
Yeah, absolutely. So it'll be available now. So it's premium.afraidtotrade.com. There we go. And we're having this /Big Mike, premium.afraidtotrade.com/Big Mike. And I apologize for that. So again, I'm not a marketer. If I were a marketer, that would have been perfect, but I'm not. So
All right,
just a trader.
So thanks, Corey. Again, I appreciate it, and for answering my questions and other people's questions. And I want to remind everybody this is being recorded. I'll post it later today on our YouTube channel. So I'll see everybody on the forum, and Corey, I hope to see you back here in a few months.
All right, thank you, Mike. Thank you for having me. Thank you for your attention, and take care, and best y'all probabilities of trading success.
Thanks, Corey. Bye.